All right, everyone, we're live. Thanks for tuning in. We'll hang out for a minute and see who else wants to join. This is Larry Mastropieri and Jerron Kelley.
How you doing, Larry?
Doing all right, man. What's going on?
Good.
Yeah.
I'm starting to get hungry. 6:15. Jerron hasn't had his meal in 5 hours. Yeah. If you hear my stomach grumbling, yeah, I apologize. Always time for food later. We got some good things to digest here. A lot of numbers,
Yeah,
a lot of data. So
we're gonna get into it here. We'll give everybody a couple more minutes, or maybe another 60 seconds or so, and then we'll get into it.
Sounds good.
Feel free to drop in the chat where you guys are from and what you're thinking about. Ask us any questions. Give it another 30 seconds or so. So. Oh, it looks like we're streaming. I don't know if we're streaming. Anyway, we'll figure this out later. Yeah.
I'm ready when you are.
Yeah, let's get into it. All right. Today we're going to talk about the market in South Florida and nationally regarding real estate. And we're going to give you all our opinions and share with you a bunch of articles and research on that topic. So if anybody has any thoughts, comments, questions, feel free to just drop it in the chat and we'll respond and we'll chat about it. So
sounds good. Let's do it.
And I'm a real estate broker here in South Florida. And Jerron, I'll let you introduce yourself as well.
Yeah, I'm a real estate attorney out of Boca Raton. Our law firm's located here in Boca. And I'm also a real estate investor too, multifamily. Larry and I share that in common. And we've done a number of deals together as well. So, yeah.
So we'll share some anecdotal experiences from what we think and how we feel the market is heading. And Jerron obviously spends a lot of time on many fronts related to the market. And I think you're a good barometer of what's to come too, just based on your business.
Yeah, we do a lot of different things in our business. That includes evictions. We do about 300 or more evictions a month, and those can obviously rise and fall based on the economy. So that's kind of a little predictor that we have, and at least an anecdotal predictor. And then our closings, as those slow down, sometimes the evictions sort of tip up a little bit and bip up. But we also have litigation and association law. But yeah, some of those things are kind of anecdotal barometers for the industry.
Title work as well. That kind of gives you an indication of how much transactions are happening.
Absolutely. Yeah. And different industries too, whether commercial or residential. So, and of course you work with a lot of investors and traditional buyers and sellers for people who want to live in properties, right?
Yeah, and what I usually say is my little world typically is just a good little picture into what's happening nationally, or at least in the hyper local market that we operate in. So it really does trend in that direction.
Agreed. Yeah. So one of the things I would say before we begin here is that we're going to kind of be jumping back and forth a bit between more local data, local statistics that we have here and we've done some research on, but also from a macroeconomic perspective. But, sort of unpacking real estate. Real estate comes in so many different forms. Geographically, like we talked about, it's on a national level, but then there's state level, then there's local data, and then, like you said, hyperlocal. What is hyperlocal? It could go neighborhood to neighborhood, even within, let's say, Boca Raton here, where we are. There might be, I don't know, it depends how you cut up the pie, but there could be 20 different markets in Boca Raton, hyperlocal markets, right?
And price points too, right? So like certain neighborhoods are going to be trading in the, call it 5 million range, and then certain neighborhoods are sub $1 million, and
all within the same zip code.
Yeah, so
totally. Right. Yeah. Some could be a gated community where you're getting those $5 million price points, or some could be right across the railroad tracks where they're, sub, maybe $600,000. So, we see that kind of over here in East Boca, see lots of that. So, and then the other thing to kind of unpack is that there's different types of real estate, obviously. So we can chop that a few different ways: residential versus commercial, but even within the commercial, there could be multifamily, anything over 4 units is considered commercial. But I like to kind of differentiate it between that commercial and the multifamily. And then within commercial, there's going to be your office, retail, industrial, can even be some other different types, weird, wacky types like airports or things like that, which we definitely won't be getting into. But those are going to move differently in different forms and different paths, based even within the same economy.
And you support investors on a lot of that commercial negotiation and purchasing, right?
Absolutely.
Yeah.
A lot of multifamily, some retail, and some industrial, light industrial as well. Office periodically, not so much in those other kind of weirder areas like mobile homes and things like that. Don't have too much of that here,
Right.
and at least in South Florida. So don't get that a lot. But yes, across the board, we do generally represent clients. So yeah.
Yeah, so let's get into what I think what everyone wants to know, and I think maybe the best way to go about this is you and I just chat about how we're seeing the market today and what's going on, and then we'll pull up some supporting data to reflect that anecdotally, right?
Let's do it.
So yeah, so what are you seeing in the market right now? What do you think's going on?
Well, I think I'd like to kind of start from a macroeconomic level because I think it's really important. We can dive into, before we dive into things like interest rates and other factors like that, I think it's really important that we, real estate is, it is defined as by supply and demand. Really, any kind of economic market is defined by supply and demand. So right now, backing up even further, if you have a really strong real estate market, you're likely going to have maybe lower supply and higher demand. That's going to push prices up, for example. If you're going to have prices falling, you're probably going to have either increased supply or lower demand or some combination of that. So what are we seeing today on a macroeconomic level? Well, we'll get into that data here, but I think what we're seeing in a lot of markets, and especially nationally, we're seeing prices falling. Maybe not like a rock, maybe not precipitously, but there are markets that we see prices falling significantly, like Austin, Texas, for example, Phoenix, Arizona, a lot of those areas that had explosive growth during the kind of COVID pandemic, 2020, 2021, even 2022, saw huge spikes in prices. Now we're seeing those prices falling fairly significantly. But there's other markets such as ours, again, we'll get into that as a preview here in South Florida, that are really actually seeing, I wouldn't say the opposite, but we're seeing either stable prices or slight increases year over year in prices, which we'll get into. So you kind of want to talk nationally versus locally. Nationally, we are seeing price declines. Locally here in South Florida, we're seeing prices, staying pretty stable, if not even bumping up slightly, right? Is that what you're seeing?
I would agree. I would say also, though, we are seeing signs of continued softening, although the recent data maybe doesn't so much reflect that. Yeah. So
for sure. So, but what might be good here, I'd like from a macroeconomic level to go through just some notes that I had put together here from an email, and I kind of sent to myself here, if we can pull that up. So again, what we talked about is that to have a massive price drop, we need to have a shift to increase supply and or reduced demand. So are we seeing that right now? Is that what we're seeing kind of nationally or even locally? Well, first of all, let's talk about the supply. In the last decade, we've seen a major drop in new housing compared to prior decades, even though our population has spiked. So might be good to maybe we'll take a look at the US population chart first, and we can see right now our population, where that red line is right at about 340 million people. You can go back historically and see that chart, that blue line has gone up, quite significantly. So we can go back to, you just went back to, let's pick a maybe like 2000. What was the population in 2000? 23 years ago, it was 282 million people. So that's almost 60 million people, 58 million people that we've added to the United States population just since 2023 years.
Yeah, I think the theme here is population is growing still in the United States, right?
So demand, that should be, demand is growing. But let's go to housing and the mortgage starts there. I think, so we just want to talk about,
let's see, we had, and then we had, construction. Here we go.
There we go. New construction. Yep. So you'll see this chart here is actually really good. You'll see that from 1950 to 59, that had about 10 million number of homes built in that decade. You'll see that hovers pretty closely over the next few decades to a little under 10 million in the 60s, a little over 12 million in the 70s, 12 million in the 80s. Same with the 90s. From 2000 to 2009, it spiked up a little bit. You got up, or a decent amount, up to about 14.5 million starts. But then look, 2010 to 2019, that new housing dropped precipitously down to 6.9 million houses. So it's about half of what it was, more or less, from the 50s through the 2009s. Why was that? That's because we had our economic crisis, our housing crisis from 2000, let's say 7 to 2010, that completely annihilated all new housing starts. For those 3 or 4 years there, you had companies going out of business. You had, national companies, big companies, a lot of local, even smaller construction companies. They just were not building because it didn't make sense when property prices and home prices were dropping by 30 and 40%, it didn't make sense to build new housing because of the supply and demand equation. So what is the story we're putting together here? You've got a growing population with a shrinking supply of new homes in the United States. That's a recipe for what? For higher prices from a very, very macroeconomic level. I could also say that population too, I highly doubt that the population is accounting for the illegal immigration that we have, not making any statements about good or bad, just from an economic perspective. I think they said in the last year, we probably had at least 6 million new unlawful entries into the United States. That's probably been going on for at least 2 or 3 years now. And then even going back before that, probably a couple million per year. That's adding to the number of population that we have. They have to live somewhere. They need housing. Housing is important for everyone, whether you're documented or you're not documented. So that's going to just put pressure on prices, upward pressures on prices. So as far as that's concerned, that's what we're seeing from a supply perspective. I'd also want to say that we've here you'll see historical housing starts kind of reflects that other chart that I showed you. You'll see in the through 2005 here, you'll see that last spike that we had down to 2009, the low of 554,000 housing starts, and then getting back up to about 1.55 million in 2022. But you'll see that 2022 number is, if you compare it to prior decades, it's not really anywhere, it's not very high as compared to what you see in 1972 of 2.36 million. That's just about what, maybe 60% of the 2.36 million number, if I'm just roughing it. Yep. So you're just seeing that housing starts are really significantly lower than they were historically. And that's a problem for prices. Or, well, I mean, maybe it's a great thing for if you want increased prices, but if you want a market that's going to be reasonable for affordability and for homeowners and young people to afford housing, that's not a great thing. So another thing we want to talk about is there's less sellers as well. So from late 2018 to mid 2020, there were around 170,000 to 200,000 homes for sale on average. Now we're averaging about 140,000 homes for sale on average. And you'll see that on the chart there. You'll see the most recent numbers are right at about 140,000. But then if you go back to maybe the 2019 range, from 2019 to 2020, that's where you're talking about that kind of roughly about 170 to 200,000 homes for sale on average. So you're seeing a lower supply of current houses. Then now we're not talking about new homes being built. We're talking about current homes that are being sold. There's a significant drop in those as well that you're seeing nationally.
And we could talk a little bit about why that is. And
sure.
Yeah.
Let's do that. Let me just wrap up a few of the macroeconomic factors that we're discussing here. Remember, demand is also an issue as well, because rates have spiked. However, they're only now approaching historical averages, as evidenced by the long-term mortgage rate chart, which we can get to if we could pull that up. Yeah, so you'll see the long-term rate chart of 30-year mortgage rates from 1971 to 2023. You'll see that we've spiked up to in the high 7s or 8s at this point, depending on who's providing the statistics. But you'll see historically, if you look back in the 1980s, you'll see that rates hit about 18% in the early 80s. I think it was about 1981 or 82 where they hit that high. And then even off of that high, you'll see that, in the late 80s, early 90s, that rates were pushing 10+% or in the high 9s. So we're just now starting to get back to historical averages. What does that mean for the average seller for a property? Why might they not be selling right now? And why might we be seeing this drop in new listings? Well, it's because most borrowers are locked into low rates. And around 40% of homeowners have no mortgage. I think the 82% of home shoppers said they felt locked in by their existing low rate mortgage, according to a recent survey by Realtor.com. So you've got these folks that a majority of people have rates below 5%, and they feel trapped, because what are they going to do? Are they going to go sell their $500,000 property to go move a few miles away, or maybe even another state away, and buy another $500,000 house at 8%, and their payment's going to nearly double? Is that reasonable? No, probably not. Their taxes are going to go up significantly. Their mortgage is going to go up. All of that is going to go up. So that's locking them in.
The majority of people that are transacting today or selling or buying are doing so because they need to. There's a real need. A death in the family, a divorce, relocation for a
You're
job.
seeing that, right?
That's exactly what we're saying.
Or maybe downsizing. So maybe you have an elderly person who's a baby boomer. They're 75 years old, and they sold their business, and they had that 4-bedroom house they grew their 2 kids up in, their adult children, and why do they need that anymore? They're downsizing to a 2-bedroom or a 3-bedroom in an adult community, right? You see that?
A lot of those individuals have a significant amount of wealth in their home.
Mm-hmm.
They usually own it outright most of the time that we deal with, and they're selling something for cash and buying something cash.
Yeah.
Right. So rates are irrelevant to them.
That too. Absolutely. Yeah. Or even they're tapping into it. And even if they do go somewhere else and finance some part of it, it's going to be significantly less, because it's very rare that you're going to see a 70-year-old that goes from a 4-bedroom house to an 8-bedroom house. Yeah. Maybe they hit the lottery, or they sold their business and they just, I don't know what, they want to show off to their friends, but that would be the exception, not the rule for you, right?
Agreed.
And what you see.
Yeah. Totally.
So, and remember, lending is another factor. Lending standards are tightening now, and we don't have the issues that we had in 2007 to 2010 with toxic debt and adjustable rate mortgages. Toxic debt is on commercial properties that reset every 5 to 7 years, and not on, I wrote commercial, I meant not on residential properties. So residential properties, yeah, maybe you can get a 15-year mortgage if you want, or a 20-year mortgage, but the lion's share of mortgages in the United States are 30-year mortgages. Not the case in somewhere like Canada. I believe a lot of Canadians have 7-year mortgages that reset every 7 years or so, maybe 5 years too, different programs, but they don't really have 30-year mortgages. It's not a thing in most other countries, which is a blessing and a curse. It's a blessing for those of us who locked in our rates at 3.5% or 4%. it's a bit of a curse for those people who didn't. And either they're the small percentage of folks that have adjustable rate mortgages, or they're first-time home buyers and they're, a 32-year-old person who's making, a decent wage. They're making $90,000 or $100,000 a year, which should be good. That's about the six-figure salary. Traditionally, 5 years ago, a six-figure salary could have easily gotten you into a home here in South Florida. Nowadays, it's not. It's not going to do it, right?
Agreed.
Yeah.
No, there's a real affordability issue right now, which goes back to why transactions are just record lows or relatively low, right?
Yeah, for sure. The last couple of factors here I wanted to mention is unemployment is one. How long would it take for unemployment to spike? Right now we have low unemployment, very low, almost historically low unemployment. Okay, well, let's say with higher rates, we're seeing rates moving up significantly over the past year and a half. The Fed's raising those rates. At what point is unemployment going to break? Well, I guess unemployment going up. I don't say positive or negative. It's different connotations. But when are we going to see the unemployment rate starting to go up and or spiking? Well, my guesstimate, educated guesstimate, is that it could take a significant amount of time. And then from the point that they actually start spiking, how long would it be until they begin to not pay their mortgages? And then from the point that they don't pay their mortgages, you're talking about probably at least 120 to 150 days before foreclosures start. And then how long from when foreclosures start till the foreclosure process ends and a property is sold? I can tell you in Florida, even if they don't contest the foreclosure, it's probably going to be 5 or 6 months until the foreclosure starts from when they're first delinquent on their payments, and then add another 6 to 10 months in until the foreclosure process begins and the property is sold at auction. So we're not really seeing significant numbers of properties in foreclosure right now. I've checked foreclosure data fairly recently. We're not seeing that spike in foreclosures that we saw in 2007, 8, 9, 10, 11 that I lived through. I started my firm in that my law firm during that period of time. We're just not seeing that right now. Could it change? Could it happen a year from now or 2 years from now if unemployment starts to spike and people can't afford the mortgage? It could, but right now that's not really a factor that we're seeing.
And most of the people that I've encountered that may have either some spicy debt on their asset, or and they're in a little bit of trouble, or just need to get out. Mm-hmm. There's substantial equity in that.
Exactly.
Property. So it's not like it's going to be this kind of fire sale structure. Mm-hmm. And then on top of that, today's foreclosures are not the foreclosures of 2010, 11, 12, 13, right? Like the banks and the asset managers have a really tight system now. They're not just dumping these dumps on the market. They're hiring real agents that are in the business that will clean up the property, get it right, and they're expecting full price for these things. They're expecting to market these things properly. It is very rare that you find a real discounted foreclosure, if at all. Now, Jerron and I were able to find one recently, which is lucky, but it's
a rare exception.
That property needed the business, right?
It did, yeah. Filled with mold, and it's taken a while to get that cleaned up. But they're out there, but it's rare, and it's again more the exception than the rule. In 2009, 10, 11, 12, it was the rule as opposed to the exception that you saw these properties, millions of them going into foreclosure. The last thing I want to bring up here is inflation. Remember, the U.S. government continues to have $2+ trillion deficits, which pushes the treasury rates and mortgage rates up. What does that mean? Well, your mortgage rates are going up more or less commensurate with the increase in rates by the Fed. But also there's another part of pressure. The pressure here is that as we continue to spend, our government continues to spend $2+ trillion in deficit spending, meaning they're in the red, they're in the negative by $2 trillion per year. That has to get funded. The Fed can print money and fund some of that, but they also look for funding from people like you and I who want to buy T-bills. And you can buy T-bills and get a more or less maybe a 5% rate on those on short-term T-bills, which is nice in this market because what else are you going to put your money into, which we'll get to maybe at the end of the video. But those rates are climbing because the supply of treasury debt that they need to fund the spending is so high, and there's $2+ trillion of it, and they need the demand. In order to create demand, they have to increase rates in order to attract people like you and I to go put our $50,000 or $20,000 into that to get our 5% return on that. So that's just continuing to affect mortgage rates as well.
Dana just asked, what is a T-bill?
T-bill is a treasury bill. So it's where the government issues T-bills, and they provide an interest rate on those T-bills to whoever purchases them, and you get a benefit of that. There's different expiry dates on those. They could be short-term, they could be 60-day treasuries, they could be 6-month treasuries, they could be 2-year or 10-year treasuries, or even longer, 30-year treasuries. So that's a good question, Dana, but it's the federal government issuing those bills to fund their spending and their debt.
So, quick example of what's going on with the T-bills. Here's an example. Look at it. Look at them climb, right? So that's just.
Well, you can see the down. If you click down here on CNBC, you'll see the actual what they're paying. So right now, your 10-year Treasury is paying 4.961%. That's the rate that you're getting on it, and you'll see that that's been spiking here since May. I mean, even before that, it was significant rate, but you've seen it increase dramatically. Until such time, my summary macroeconomically is this, and then we'll get into more maybe statewide or micro analysis, is until Congress and the government gets our budgets under control and we have significantly less deficit spending, we're going to continue to have inflationary pressure. And that inflationary pressure on the overall market also creates inflationary pressure on the real estate market and real estate values. So while we have things that are working against that, like increased rates on mortgages, that should technically on paper be reducing prices. Normally in most markets where rates increase on mortgages, prices should come down. That's not happening here. And the reason why it's not happening is we have an out of control federal government that's just printing money. That's that's my top. Whether you agree with that or not, it's a fact, So whether maybe you like it, maybe you don't like it, but you just have to understand that there are consequences to that.
I think a good comment on that is, let's see here. Let's see. So this is a memo that we from Howard Marks, super smart guy in the finance world. And one of the comments he made is, for a number of reasons, ultra low or declining interest rates are unlikely to be the norm in the decade ahead. And that goes back to many comments that Jerron just made. Historically, interest rates were floating around this rate, the rates we're at right now. 2, we have a lot of debt, and it's hard to unwind that nationally, right? So because we have a lot of debt, 10-year Treasury is going to be higher. And so that's going to push up rates structurally, not because the Federal Reserve is raising the overnight free funds rate, but because structurally the T-bills are higher, right? The interest rates are higher. So that's a perfect example of what Jerron's trying to communicate here, I would say.
Yep, for sure. Do you want to dive into maybe some more local type of stats that we have here?
Talk about it. So most of what you just said was pretty much in line with what we're seeing locally to a degree. We just have some nuanced reasons why that's happening. So let's talk a little bit about that. I think a good start might be this chart here.
Let's do it.
So let's just go over a little bit about what's happening in the single family home residential market right now, where I spend a lot of my day participating in as a broker. So this is the Q3 2023 single family home report from the Florida Realtors, right? And so what we're seeing is closed sales in Q3 compared to Q3 of last year, actually not too different, right? This is pretty close, 3.5% less than last year's Q3 than 2022.
Pretty stable though.
Yeah, pretty stable. So South Florida or Florida in general is doing okay as far as transaction volume. And if you go back down to actual dollar volume, you'll see the same thing. 38.2 billion this quarter and 37.9 billion in Q3 of 2022.
So an actual increase year over year, slight increase, just because property prices have increased.
And to go back to that point, so median sales price in Florida overall is 414,000, and Q3 of 2022 it was 409. So again, we're seeing a little bit of an increase. What I found interesting was this metric, because I hadn't seen this put out anywhere else recently. So 19,000 people in Q3 of 2023 purchased cash, and Q3 of 2022, 894,000 people purchased cash. So not much of a change here either. I mean, that's an 8% change, but I don't know. That's not too massive to me.
Not too massive. To speculate why that might be, my guess might be more that we saw our COVID influx of people coming from New York and California and those higher priced markets. At that time, they were higher priced. But I've also seen data recently where the Florida market is now more or less on par with, or certainly the South Florida market is more or less on par with some of those higher end markets like New York City, San Francisco, LA, where they've actually maybe seen a little bit of compression in their prices, certainly as compared to ours. Maybe they've seen a little bit of growth in price, but nothing compared to ours, because it's just supply and demand of people again. So meaning they're having population loss from those states, and those people are moving to these states like Florida, Georgia, North Carolina, Arizona, Texas. Those are the population growth states. And so I could be wrong here, but I would just speculate. We saw that spike in people selling at much higher asset prices 2-3 years ago during COVID. They moved here. Not that there aren't still moving people here, because there are, but just not in the same quantities as there were a year ago or 2 years ago. That really, it was like it just really fast forwarded at least 2 or 3 years worth of migration, maybe even 5 years of migration in such a very short time frame.
The argument
like a 12 to 24 month time frame.
The argument is that demand was pulled forward during COVID times, and so
demand was pulled forward. That's a good way to say it.
We should expect healthy growth, population growth in Florida, just because people are still moving here, but maybe not at that pace.
Not on steroids like it was.
Yeah, exactly. So that's and I think the other comment around why so many people are paying cash is you have that 60-year-old and up population that have accumulated a lot of wealth in their primary residence, wherever that may be, like you just said, New York, Chicago, California, and they may be relocating to South Florida or Florida in general, and they're able to go to Orlando as an example and pay that median price of $400,000 because their home wherever they live is maybe worth $1 million.
Exactly.
And they might have all that cash, so that would be their retirement play. So we're seeing a lot of that. I thought that was interesting, though, that people are still paying cash.
Yeah.
Quite a bit of people are still paying cash.
For sure.
Which is neat. And then also some other comments around this overall.
Well, one other thing, sorry to interrupt you, but if you do the numbers here, look in Q3 of 2023, for example, closed sales, 66,000 and paid in cash is 19,000. That's about, I'd say 25%, a little more, maybe 26, 27%, just doing rough numbers off the top of my head. That's a lot. That's, I don't know, nearly roughing it up. Yeah, roughing it. It's nearly a third. Yeah.
Yeah, that's substantial.
That is substantial.
And so we're still seeing that to this day, despite everything that's changing in the economy as a whole, right?
Yep.
And then I think something else to comment on here from this chart is the median time to contract. So from the day a listing goes active to the day a listing goes under contract is now 27 days, and previously it was 16. And locally, we can jump around a little bit here. Locally, this is a little bit of the data that I do every quarter and put together personally. You can see the average days on market in South Florida, this is specifically Palm Beach County, is now 53, and previously September of 2022 was 33. So we've seen a 61% gain in that, and overall, you can see here it's been, look at that, 68%. So
Yeah.
kind of
It's taking longer to sell a property. You get it listed, and it's taking almost 70% more time to sell that property.
Yeah.
Yeah.
So that's where we're seeing a little softening in the market.
To get it under contract, 70%. Yeah. Still 23% longer to actually sell it.
Yeah. I think this number is what I dwell on the most, right? Yeah.
Right.
And so this is where we're seeing a little softening. We're seeing it more, I think, at this moment in time. Anecdotally, these numbers look really good, and same for Palm Beach County. This data looks great. I mean, if you look at the median sale price in Palm Beach County, today it's $464,000, or at least September it was $464,000, and last year the same time $425,000. That's a 9% growth in median sale price, right? That's pretty substantial.
That is
a big number. So that's great,
especially in an economy where other municipalities and other metro areas, again, like Austin, we could go Google that, but Austin has seen year over year, whatever the number is, but it's something significant price drop, 20% or something like that. Where we're having price growth, 9%, 9 to 12% price growth, depending on if you're talking median or average, and other metro areas are seeing significant price drops. Really just shows the amount of demand here in South Florida that's coming in.
Yeah, and then overall, another thing to comment on would be just inventory. All the active listings in the market here in Florida: 68,000 active listings as it stands in Q3, 66,000 Q3 of 2022. So again, we've been relatively stable over the past year. And Jerron and I were talking about this earlier. Rates overall recently, they've, over the past year or so, let's jump to a year, 3 years, here you go. So over the past year, they have gone up, right? Now we're sitting at, according to this document, 7.63%. And a year ago, we were sitting around, let's see, this is July, August, September. We're sitting again around the 6.29. So rates are at least 1% higher today than they were a year ago. But generally, active inventory is still similar. Prices are still up. It's pretty interesting to see this market and how it's holding its own despite everything that's going on, right?
Agreed.
So let's talk a little bit more. So we've kind of gone over that. I think what's probably worth chatting about is just what's going on in the investment world. I think you and I, we enjoy that. So we can talk a little bit about that.
Sure.
Let's share. So what are you seeing right now from an investment perspective, Jerron?
It's somewhat, well, first of all, let's break up the different asset classes. So office is suffering in most areas of the country. Office has taken significant hits. I saw the story in San Francisco a few days ago. What was the building? I think it was worth, essentially took a 50% haircut. It was like $500 some million just a few years ago. Now it's being foreclosed on, and it's estimated that's worth $200 some million. So you're seeing markets like that where office space is taking 50% haircuts. Is that happening here in South Florida? No, that's not happening in office. In fact, I think you have this pulled up here, Larry, if you want to share that. So office in South Florida, this is a Marcus Millichap report for the fourth quarter of 2023. You'll see that they've added 8,000 jobs, or 8,000 jobs will be created in this quarter. And then you'll see the interesting thing is the vacancy. It says the majority of new supply will be absorbed. However, expiring leases signed prior to the pandemic push up vacancy in 2023. Still, the Metro's year-end rate of 12.4% stays under 2019's measure by 80 basis points. So, meaning we're in a better place today than we were in 2019 before the pandemic, which is pretty significant in a market where office is getting massacred nationally. So again, just shows on a more micro targeted area here of Palm Beach County, that you've got strong demand, even in a class that's as hard hit as office. And then you'll see the rent. West Palm Beach's average rent held relatively unchanged during this year's first half. Marginal bump is expected over the final 6 months, bringing the mean asking rate to $30.25 per square foot in 2023. So you're actually seeing rent increase slightly by 1.2%. So again, asset class like office should be getting killed. Nationally, it is, but here in South Florida, especially Palm Beach County, it's doing fine. It certainly had increases and lately has been treading water here. You'll see that chart right there, the rent trends. You'll see average asking rent per square foot. Those blue rectangles there. You'll see that's the actual average asking rent. So it's been increasing year over year over year. The orange line is the year over year percent change. So you're seeing that decline, but all that means is that the percent change is getting down to near zero. So it's now more or less hovering as far as the rent trend right there.
So yeah, so office isn't getting crushed at the moment.
Not here.
Yep.
Yeah, not here.
Yeah.
But then, yeah, multifamily, I think certainly here in South Florida has seen significant increases in price increases, just like you see here with office. We don't actually have any data we were prepared for with that, but was actually out at a social event yesterday with a couple of very large apartment owners. One gentleman owns over 700 units here in Broward and Palm Beach, Broward and Miami-Dade, a little bit in Palm Beach County. The other gentleman owns nearly 200 units. And then, of course, we're with our friend Daniel Cunningham, awesome guy, great multifamily broker at Marcus Millichap. He was at the same event and was talking to him. And, we're all in agreement that we're seeing multifamily slowing down here. Prices are more or less stable. Certain areas, maybe you're seeing a little bit of dropping of prices, getting a little softer, a little softening in the market, but it's not crashing. Yeah.
I've seen in the past 2 weeks, I've received more phone calls on multifamily deals that are slightly more interesting. They still don't work.
Yeah.
They still don't work. And getting debt to put on those deals, efficient debt is a challenge for many reasons. We could talk about that, but recently I'm starting to see some more people come to me with opportunities, and we'll see if that continues. We'll see if that's just like one blip in the whole overall scheme of things. But I think we're starting to trend in that direction where things are starting to adjust a little bit, possibly. Sellers are becoming a little bit more reasonable. At least that's what I'm hearing from.
Certainly hope so.
From multiple brokers recently.
Good.
But to your point, in most cases, prices haven't really changed too much.
Not too much. What is going to be the big difference in commercial real estate, whether it be multifamily, office, industrial, retail, is the fact that their financing is so different. We talked about this at the beginning of our stream here, is with residential real estate, you're mostly dealing with 30-year mortgages, sometimes 20, sometimes maybe 15, but the great majority are 30-year mortgages. Whereas, as you know, you have a lot of multifamily units. You've got you and your partner have around 90 units on all your properties. You have shorter term debt, and I know I do too. Typically 5 to 7 years, and every 5 to 7 years, that rate is going to reset at the prevailing rate in the market. So it's a little worrisome. I know you and I bought a few properties around the same time a couple of years ago. So we've got maybe another, give or take about another 3 years to sweat this out and hope that our rates come down a little bit before those rates reset, or else, our margins are going to be compressed significantly. And, we bought at a good time. Imagine if we bought properties a year ago or a year and a half ago where, prices had already spiked another 20 or 30% here, and the numbers just may not work. And I think that, I've seen the statistics. They talk about $1.5 trillion of commercial debt that's going to be up for rate changes here or needs to refinance. in the next 4 to 5 years, it's going to get worse and worse. And I think that's going to be a slow snowball effect. I think it's going to affect the banking sector, especially regional banks, which carry most of this commercial debt. A lot of the bigger banks have a smaller footprint in that area, and we'll see what happens. Again, I don't anticipate that it's going to be something sudden like 2007, where just the whole market fell apart and banks just overnight, Lehman Brothers and all these big banks, just crashed, and we thought the whole economy was ending in the 2007 2008 timeframe. Probably not going to happen like that. This is going to have a different play, but we'll see. We'll see what ends up. What are your thoughts on that?
I think if rates stay where they're at, we're going to see price adjustments. We're going to see prices come down.
Just has to be
in the multifamily space, at least, or in the commercial space.
Yeah.
The residential world is a little different, right? It's more supply demand based. There's no return on investment analysis typically done when you're buying a residential home. So here in South Florida, when you're buying a residential home, especially Palm Beach County, there's not a lot of room for new construction. So we're just not adding new inventory. So the population continues to grow like it has. Prices may hold stable just for that reason alone. There's just not enough housing for the amount of population that is moving to this area.
Agreed.
As far as commercial real estate, especially our stuff, like you said, if as people, give it another year, 2, rates are still where they're at, things will change.
I think so too.
Because there's and it depends on, obviously there's different asset classes, right, in multifamily. So they're adding more Class A product than they are Class C product, which is a lot of what we own.
For sure.
So there may not be much of a, the rents may continue to stay strong in that Class C product because they're just not adding more of it. Yeah. And any affordable housing that they're building right now is not really affordable, right? So compared to what we own, right? So it's just, so there really isn't any new product coming to market for the Class C stuff.
Yeah.
So there's a good chance rents hang in there and or go up, and well, that is directly tied to a return on investment. So
yeah, a lot of factors that go into this, and like you talked about, Class A, Class B, Class C housing is different. Class A, you have people that are in the information and gig economy, and or people who are retirees here, people with a lot of money. So in some ways you can make an argument that Class A may not be as affected, depending on how much inventory there is in a certain area, by rates, and we're seeing that with some of the data here with cash, a lot of these cash buyers. Whereas in Class C housing, if you see unemployment starting to tick up and the economy slowing, jobs start shedding, which we haven't seen yet, but I'm just saying hypothetically, if in 3, 4, 5, 6 months we start seeing that, there's only so much that workforce tenant can pay. I mean, they just, they're pushing the limits of what they can pay. Typically it's kind of like the 1/3 rule that people can use about 1/3 of their after tax take home pay towards housing. We're seeing tenants, paying way more than that kind of 33% right now, let alone, if rents were to start to rise. And I'll just give one little tiny piece of anecdotal evidence of this. Is just recently one of my 2-bedroom apartments came up for rent, and we share the same property manager. So his name's Aaron, great guy. And started off, I started off, it's a pretty good location. So I said, you know what, let's test the top of the market. Very little supply out there of 2-bedroom apartments. So I thought, hey, I've got all the cards here. Well, I put it up for rent at $1,900, which I knew was at the top of the market for the type of workforce property it was. Certainly not been completely refinished and rehabbed. But I thought I'd throw it out there. Well, it stayed out there for about 5-6 days, and there were 4 people came through, but none of them put any offer, showed any interest on it. So I told them, you know what, let's drop it to 1,800. Did that for a couple days, had a few people coming through, but then I ended up dropping it to 1,785, and I got my tenant. But I had to drop it $115, which It's still 1785 is decent for that area, but certainly not the 1800 to 2100 that I've seen of certain 2-bedrooms can get even in workforce housing in certain areas. So I don't know if that one piece of anecdotal evidence in my one experience in the last few weeks with renting an apartment out means anything yet, but we'll see. So
yeah, I think we have reached the max limit for affordability on rents. So the comment about, rents potentially growing, it's hard to wrap your mind around rents going higher than they are right now, at least for the Class C affordable income type properties.
Yeah.
Yeah. So rents can't grow much, if not, and they may come down a little bit. There's a little bit of softening to your point. I'm feeling it too.
What I think happens a lot of times, especially with the workforce housing, is what people do is they start sharing
Putting more
apartments.
people in it.
Yeah. Maybe the adult child who can't really afford that $1,800 a month apartment anymore, the 26-year-old, moves in with their mom and they go back to sharing in a 2-bedroom apartment, or they squeeze 3 adults and a child into a 2-bedroom. And just you start to see that happening in these types of changing economies.
We definitely see it. We definitely see it, and we're seeing it more and more everywhere. And I feel like things are softening a bit. I'm still surprised though in moments that I'm getting certain rents. So depending on the little micro markets, you and I own stuff all throughout Palm Beach County. So like we can have this like micro discussion. Sometimes I'm feeling like Boynton Beach and the 3-bedroom, 2-bath product that I own there isn't renting as strong as the 2-bedroom, 1-baths in certain parts of Lake Worth.
Sure.
It's kind of wild.
It is
to me. So it's definitely location, right? But I think overall, if I had to quantify this, we are experiencing some softening in the rental market right now.
I think so too.
Although the data that we're all looking at here doesn't so much tell that story.
This data is also, just keep in mind, almost all data is trailing data.
Exactly.
So you're, we'll see. What we're talking about now, again, my anecdotal story may be completely bogus. Maybe it's just, maybe I need to change the floors out on the property, which I probably do, so maybe that's all it was, but maybe not.
Those vinyl peels.
But that's the first time it took a week and a half and a long time to rent a property out. It's been several years since it took a week and a half
to rent a property out. A week and a half. That's like a record time in the grand scheme.
In the grand scheme of things,
right?
sure.
Yeah.
But during COVID, I mean, literally, you would put a property and you'd have 5-6 people making offers on it. Yeah, they'd be blowing up your phone. So
now it takes a week and a half to rent something.
I know. Woe is me. Woe is us. Yeah. So good.
Yeah, that's very interesting that we're experiencing the same thing. I was talking to another investor that you know pretty well as well, and he was explaining to me he had 20 plus properties on the market for rent right now in his portfolio, and he was just saying, "I'm having a hard time renting these."
Wow.
That's
better anecdotal evidence, because that's 20 as opposed to 1 unit.
Right.
So, yeah.
And he was saying. And his type of product is a little bit better in most cases than some of the stuff we have some good stuff, but overall, a little bit better quality than ours. And he owns primarily condos, what I'm talking about. So he's having a little bit more trouble, and that's because he has to rent to a certain class of people that need to get approved by an association, et cetera, right? So the cracks, I think, are a little higher up right now in the system, the B's, the C, or the B's, the A class properties.
Got it.
More so than our stuff.
Yeah.
We have complete control of whoever we want to put in the property, right?
Yeah, I stopped buying in associations. I've still got a couple, 3 condo/townhomes, and I dread every time a tenant moves out, because it's the whole 3 to 4 week process from the point that you find a tenant to when you can get them approved, and it just kills your ROI. Yeah.
In most of our properties, you just said you rent it out in a week and a half now, and usually those tenants are moving in within a week of that time.
Oh,
so
yeah. Oh, easily. Yeah. Sometimes the next day.
Off the market and under contract, everything done. They're in the unit in like 3 weeks tops.
Yeah. Like a lot of times it's a lot less than that. But that's the association properties. They can be brutal.
Yeah. So that's the benefit of owning just standalone
Yeah.
assets. Yeah. Let's talk real quick
Good.
before we finish up. We can just comment on some of this multifamily stuff, but
Sure.
this is the Marcus Millichap report, Q3 report. So this is a little backdated, but this is the most recent one. And you can see here the vacancy has gone up a little bit, 80 bips, right?
Mhm.
Which is not substantial. The rate will reach 5.9% by year end is their prediction, right? So that's kind of interesting. And this takes into account Class A, Class B, Class C. I would argue, as we just talked about, Class C, the vacancy is probably much lower than that. So anyway, it's maybe a little bit more difficult to keep some of those Class C tenants, but sometimes I don't think we really have much of an issue. Do you have much of an issue keeping tenants?
No. Still, even everything I said, still supply is constrained. It still is constrained. There still may be so we're talking about two different things that are kind of competing factors. You've got supply constrained, that they're just not building multifamily housing here in South Florida, especially not Class C multifamily housing that we rent with. But on the other hand, I just think there are limits to people's incomes, and there's only so much that they can pay to rent. And I think we're testing those limits and those ceilings.
Yeah, we're there. I can't see it.
Yeah.
Yeah. And what's interesting is also you can see the rent data here. We're up 1.8% overall on the effective rent. And they're saying still the average effective rent will reach $2,460 per month in 2023. So again, rents are still climbing per this report. I do think, though, as we're rolling into the last quarter of this year, we're seeing softening. I think some are pulling back a little bit.
Yeah.
That's what I'm experiencing. That's what you just explained. Yeah. And that's what some of the other large investors we know.
But notice we're using the word softening. Softening means coming off of crazy increases.
Yeah.
Not a crash, not the world is not ending. I'm still looking at properties. Doesn't mean that there's a lot of deals out there, but if I found the right one, maybe something creative, maybe seller financing, maybe assuming a mortgage, I would spring on a deal, because I think let's say short to medium term here, again, something crazy could happen, and Congress could get their act together, and we're going to have less deficit spending, we're going to have less inflation, and prices start to come down with that inflation, and then we can actually lower rates as well and get more people into owning. But for right now, the kind of short to medium term, I just don't see it, and I just think we're going to have higher prices, not necessarily increasing prices, but I just don't see these prices crashing in the short to medium term. It's just not here, certainly.
Yeah, I agree.
That's my kind of summing everything up. I also don't see rates coming down for a while. Yeah. Some people are I think they have hopeful and wishful thinking that the Fed's going to be able to lower rates in 6 months or at some point next year. I just can't see how they're going to be able to do it. Inflation is still in the high 3s, low 4s, depending on if you're using CPI index or some other index. We're seeing no signs of it getting back to the 2% or sub 2s that the Fed wants. It's just, they don't have it fully under control.
I think the theme here is rates are probably going to stay elevated for some time.
Mm-hmm.
Sellers on the investment side, on the multifamily side, may need to adjust their price in order to continue to sell, and that's going to take some time. Right? It
will.
Yeah.
It's gonna, and I think you're going to see many more motivated sellers in commercial, multifamily and office retail on the commercial side of things, because their rates are going to be adjusting, and I think they're going to feel some real pain coming up. So, and that again doesn't mean it's happening next month or even 3 months from now, but it's going to be a slow burn, and it's going to be happening over the next year, 2 years, 3 years.
Overall, though, to your point, if a deal appears, I'm doing it. Jerron's doing it. So we're still
buyers.
We're still buyers.
Mm-hmm.
If the
smart buyers, but buyers.
The math works. The math has to work. You do an investment deal to make money.
Mm-hmm.
You don't just buy something to lose money. And right now, most of these asset prices and the debt you have to put on them, they just don't make money.
Yeah.
So,
Right.
which is why transactions have slowed so much in that space.
But what does make money? So that's the final question that we all have after we have these discussions. What makes money right now? You know, the stock market's not doing well. Get rid of those 7 top companies, and you know, the market's down. It's down significantly. You know, and it doesn't look like it's headed up from here. So, you know, do you put your money in equities and lose money in that? Do you put your money in a bank account and lose money with inflation? Do you put in gold? Who knows what gold's doing? Gold normally goes up when interest rates go down, but if rates are going to stay high for a significant period of time, or maybe even go up some, is gold really going to be the answer? Probably not. Bitcoin has had a big run here. Everyone has different opinions on Bitcoin. I'm a little more in the camp of it's pure speculation. I could be wrong. Maybe you take a Bitcoin play. That's not my thing. So only other thing I can think of is putting money in a money market account at 4% or 3.5%, or put it in a treasury bill at 4.9 or 5%. And at least you're maybe kind of staying even with inflation if you believe the, official inflation stats, which I think they're a little below what real inflation is. So I think you still may be a little underwater just putting your money in some kind of, money market account at 4%. So,
yeah.
I don't know.
My plan is just stay patient, continue to stay smart about what's going on,
Mhm.
understand the market. So I'm underwriting deals, even though sometimes I already know they're not going to work. At least I'm getting a clear understanding of what's happening in the rental market, what the comps look like, and what actually ends up trading, because then I know I've been in the asset and I've seen it sell. And so when I see a deal, I can compare it to that one that sold for X amount more or whatever. So I think just continuing to be patient and chop wood and carry water, right?
Chop wood and carry water. I like it.
Yeah.
Or I'm keeping my powder dry.
There you go. Exactly. Cool.
Good stuff. Well, yeah,
I think that's it.
I think we got through most of it. Hopefully everyone got a lot out of this. If you have questions once we post this on our channel, feel free to reach out to Larry or I. Our websites will be in the description, and you can always feel free to reach out to us. Our law firm is Kelley Grant Law. You can go to our website and give me a call or send me an email if you have any questions. Larry, go ahead if you want to.
My brokerage is Florida Homes Realty, and feel free to give us a ring. You can find us online, the Mastropieri Group, and our information is obviously on the site as well. And thanks for tuning in, guys. Thanks, Antoinette, Michael, Dana, James, everybody. We'll talk soon.